Hello everybody, welcome to the Cyclical Investors Club. My name's Corey Kramer. Today I'm going to be making a little bit different kind of a video, and I'm going to share with you, 5 stocks that I recently sold just as kind of a housekeeping, kind of a portfolio clean out. And I do this, occasionally, usually at least once a year when the market's kind of doing what it has been doing and not really going too far. So I'm going to kind of take you through my thought process on some of these stocks, which ones they were. I've made videos on most of them, I think, at one point. But I think I've only made buy videos on one, I think. And that's Comcast, the one that's up here right now. So as always, this is not individual investing advice. This is just how I analyze stocks. And usually I make videos where I'm just doing an individual valuation analysis and then general thoughts on various stocks that are in the S&P 500. I'll often get asked about, I don't know if I've made like a sell video of stocks that I actually own yet on the channel. So this will be the first time that I do that. Now, usually I'm aiming for the medium term, unless something really weird happens. I typically am holding a stock for several years and waiting for the kind of thesis to play out, usually at least 2 years. And then with some of these, we're getting more into like 3 or 4 years, where I have a little bit more time to watch the stock, see if my expectations happened, if the market behaved the way that I thought it would, and so forth. So, and some of my standards have changed a little bit since I bought all these stocks, honestly, except for maybe one of them. So I've made some adjustments to my overall strategy that have actually kind of tightened my parameters a little bit, made me more selective of stocks, and tried to up the quality and the growth potential. And so as those changes happen over time, there are stocks that don't really fit as well into that. And I don't necessarily just run out and sell everything that fits with adjustments that I'm making. I kind of do everything in a pretty slow process most of the time, unless it's like the beginning of COVID or something like that. So let's start with Comcast. I have made videos on Comcast here before, even at the very beginning of the channel when I ran for like 3 months and shared some ideas. My main point with I bought Comcast at the very beginning of the COVID crash on 2/28. It was almost, like right here. Let's just take a look at how it's performed since then. It's basically flat. I think with the dividend I was up a couple percent. So like 3.66%. And so it hasn't really done anything. Of course, inflation adjusted, that's down maybe like 15% or something like that. So it hasn't done well. But when I shared it on the YouTube channel, I really shared it as an alternative to, I don't remember what dates those came out either. I think it was the beginning of 2021, where I shared it as an alternative to Disney. And if we look at Disney over the same time period, it's actually, we'll just do the time period that I bought it. It's actually worse. So even with the recent kind of surge that we had here. And when I made the video for it, it was at the beginning of 2021. So like in January, I think it was right around here actually. So since that Disney / Comcast video, where I said Comcast was a better buy than Disney, Disney's down like 40%. And we'll take a look and see what Comcast is down over that time period. I think that was Feb 5th when I put that. So it's down about half that, about 26%. But most of that time, Disney was down significantly more. But they both are facing this similar challenges. I actually think Comcast, of the stocks that I'm selling now, probably has the most potential to do okay over the medium term. But the core problem is cable just has too much competition now. And streaming has competition, and people aren't going to the movies like they used to. And Comcast has quite a lot of debt. So they have some financial. Let's take a look at the basic earnings here. So we can see that really this kind of spike outlier here, if you look at this time period of the past 1, 2, 3, 4, 5 years, really they haven't had any real kind of earnings growth. If you're just using kind of the basic earnings, and the market is kind of soured on the idea that they're going to be able to recover. So they really should have recovered. Well, the stock price did recover at first during this kind of surge in streaming happiness, and then reality set in. But I would have expected that 2 or 3 years now after COVID's basically faded away, that the stock price should have continued this trend that we saw in 2023 up, and this trend that we see now since then, basically for the past almost year, where that's reversed, I think just kind of shows that they probably aren't going to recover at the same speed that I would have expected. So that's one of the reasons why I'm going to go ahead and I actually sold this one today. So I've sold all these today. Because I've been buying. I haven't posted all of them on the YouTube channel because they're mostly my growth strategy is what's finding stuff right now, and things that aren't necessarily in the S&P 500. I did have one oddball pick from the S&P 500, but it was so weird that it didn't really fit any of my strategies. It's always weird to make videos and I don't have very many. I have maybe 4 or 5 oddball stocks that don't fit my strategies that I decided I'm going to go ahead and take a chance on, and so I had one of those. But the rest were mostly growth strategy stuff that I don't make videos publicly. But I bought 6 stocks in May, which is more than I bought in a month since probably, 2020 at least. So I've been buying more growthy stocks, which are more volatile, and so I kind of want to balance that out with a little bit more cash at the portfolio level. So I was 30% cash. I sold 9 stocks. I think I was 31 actually. And so I sold 9 stocks, 5 of which I'm going to talk about here. The rest were REITs. I didn't own very many REITs, but I think a lot of these stocks you're going to see are financially sensitive. That's kind of the theme that runs through most of them, other than Comcast, which is more of a growth, and then also BMY, which again is more of a growth problem. But the rest are financial. I would say they're sensitive to financial system and credit cycles potentially, as REITs are as well. That's the underlying macroeconomic theme. And then the portfolio thinking is most of the things I'm buying now are cyclicals that could still fall a lot. I think I posted Norwegian on here a couple weeks ago. Things like that. They are economically sensitive. In some ways, they're like these other stocks, but they have, because they're cyclical, they have within them the potential of big returns over the medium term if they come back, right? Or if the economy bottoms or their customers kind of come back. So I'm buying cyclicals, which are riskier when they're really beaten down, 50, 65% off their highs. But they have the potential for the big returns, the 100% returns, the 200% returns over the medium term to offset that extra risk, right? That's my thinking behind it anyway. So, and we really haven't seen, some of these cyclicals are very good businesses that I haven't bought that many, 3 or 4, but there hasn't been any at all until just now. It's been really hard to find. I think in terms of standard deep cyclical buys, I bought refiners in late 2020, which was a very high conviction pick. I actually overweighted them, and that turned out really great. So it's been probably 3 years at least since I've seen more than one at a time come up that actually looks that's 50, 65% off its highs or more. I guess I picked up a couple semiconductors when they crashed, AMD and MU, but that's 2. So every now and then I've seen a few in very specific sectors, but in terms of like a whole swath of like industrial cyclicals, or consumer sensitive cyclicals like airlines and cruise lines, just now I'm starting to kind of see those deals potential deals happen. At least the prices are cheap, at least. But it's nice to have extra cash to offset that extra volatility. And then the Fed still has interest rates, pretty high, and they were pretty hawkish at this last meeting. So that was kind of the last straw where I was like, okay, I don't get the feeling anyway the Fed's going to come in early and try to really do everything they can to prevent like an economic slowdown. For a while, it seemed like they would, but this last meeting, it just didn't seem. I don't think they're even worried about like a recession now, or it's not in their mind. So if they're going to really wait for the real data to turn, that's going to be probably too late. We'll at least get some kind of economic slowdown. It might not be like a bad recession or anything, but before I was I thought maybe they might come in early with like some cuts next month or something, and kind of get that cycle started a little early. But I think they're too worried about inflation to do that. So that's kind of where I'm at on that, and they've been flip-flopping all over, so it's hard to really gauge that too much. So when we move so that's just a macro and portfolio kind of big picture looking down view. Now let's get into a little bit more of the individual stocks. So Bristol Myers has been a big underperformer for me. Let's see, I bought it in December 14th, 2020. So this is one of the few stocks I bought in 2020 that didn't really work out. That's pretty close to where I bought it. And then recently it's just kind of fallen off a cliff. I think it's down like 35%. We can see that the adjusted earnings are expected to crash this year. And basically they bought Celgene. I'm looking at my notes here. I think Celgene was 2019. And I thought when I was looking at it at the time that they paid like a pretty good price for Celgene. But the problem is it doesn't look like they got any growth at all out of that deal. And what they've been doing is continuing to buy like more pretty big purchases, and debt is pretty high. We can see here. And again, if you look at those unadjusted earnings, you get probably a clearer picture of their struggles. There really hasn't been, when you take into account the years that they lost, this is a total loss actually, like 2 years worth of earnings almost. So when you look at this, basically they haven't earned any real money, for like 10 years. And the prospects that something might come along, they look to be getting dimmer rather than better. So I think this is one where I'm just calling the thesis. I usually buy these drug companies when they look cheap, and I hope that they come up with something. And after almost 4 years, 3.5 years, it doesn't look like that's going to happen. So I'm just going to cut this one loose, take my losses, and move on. So that's the story there. Now the rest of these are a little bit more financially, I would call like financially sensitive. So one I've had a lot of questions about. I made a video about global payments, why it doesn't look as cheap as it does, why it probably isn't as cheap as it looks when you count the debt that they have, and when you look at, again, these basic earnings instead of adjusted earnings. Similar story where not really any growth, and these are just forecasts, and usually these are not good forecasts when you use the basic earnings. So they did okay in terms of earnings last year, but they had such a bad year the year before, and when you balance it all out, earnings are still going nowhere. They bought they merged with Total Systems in 2019 again. So a lot of times businesses will do these big mergers when their growth is slowing, like when they're just having problems growing. Then they go out and try to do M&A to try to either consolidate competition or, get rid of people, because you can do, the same job with maybe one person if you have one company instead of two, synergies or whatever. And so that's when they usually go try to do that. That kind of fits this pattern. They were growing pretty well up until I actually hadn't looked at this yet, but yeah. So they're growing pretty well from this decade. I mean, they have one blip down during the Great Recession, but even the gap earnings had tripled probably. They had this tough year. I'm not sure what was going on this year with their accounting, but we see that started to slow and decline in 2018, and then we get this merger, right, to try to counter that basically. And we also see that started, well, maybe they paid a dividend before, but they started boosting this dividend to try to attract investors because the growth wasn't there. So I think this is just one where I don't see a lot of future growth when I look 5 years out for these guys. And that's in this environment we're in right now. That's what I want to see. And I see the larger debt, right? Just more financialized in general, with higher interest rates. Eventually refinancing is going to come, and I didn't look specifically for these guys, but this is just the general situation that we're in. So yeah, I think I'm down like 30% on this one too. Let's look. 1/4/22 is when I bought. So I did buy it when it was well off its highs. Give myself credit for that. Like right in here. But things just didn't get better. So yeah, about 30% loss on that one. All right, so I think I've covered, let's see. Yeah. Okay, I've covered the ones I lost money. I'm going to take profits in a couple that I have made money on. So again, going in the similar industry, we do have some debt here too. So these guys, what did they buy? Did I put it down? WorldPay. So they bought WorldPay. I forgot to write the year down, but it's back around the similar time the rest of we saw this M&A going on. And basically, WorldPay did not work out. They were probably trying to get some growth, some new growth, and it didn't work. And then they spun that off, and you see that drop in earnings this past year. So again, trying to get growth, M&A doesn't work. They at least kind of, I think, recognize that and spun it out and are kind of starting from a new base again. So there is some hope that you can that this one can grow again. But I don't see any of the initial problems that have gone away. So again, if we look at the basic earnings, we see kind of a different story than the normal earnings, where they fall down. These are big, huge losses. And then you can see the stock price followed. So I bought this one really because I thought that the initial sell-off was kind of overdone, and it just got so cheap I decided to take a chance on it. It was less probably about the long-term potential and more about the mean reversion, and just market overreacting too much, kind of buying after a crash basically. So I bought this one 11/3/22. Yeah, so you can see right here basically on this gigantic drop. It fell like 20 or 30% overnight. So I took a chance on that. It's up about, I think, yeah, it's close to 35% with dividends. So nice little, I feel like the exaggeration of the crash that happened has kind of leveled off. The market's, feeling better about it. But I think probably like the longer term growth is still going to probably be challenged. And it's recovered, back to probably like a normal PE. And they could be economically sensitive if the market slows down and things like that. Or if banking in general kind of slows down, which gets us into the next stock that I sold. So again, I want higher quality, and less debt usually, or really deep cyclical value where the price is sold off deep. So UMBF, I did extremely well on this stock. I bought this one, I've bought it twice now. Once was during the pandemic, during March, near the bottom here, and I want to say I did like 160% on this or something. Sold around the peak. I think right when it started coming down, maybe. I don't know if that's the exact date, but yeah, like 130 to 150%. Did fantastic. Also sold at the proper time when the bust of the pandemic started coming. And so I missed out on all this decline. And then we had the banking crisis, right? And the stock price crashed. And so I bought it again, kind of with the crash theme, 3/20/23. So that's pretty close. And I'm up, about 35% on this one, 35 to 40. So I've done well on this. But again, so the initial idea was that deposits were fleeing banks and it was causing them to go under, basically. And I thought with UMBF's customer base, unlike the kind of San Francisco or New York customer base that were racing to the exits as fast as they could, it didn't seem to me like UMBF's deposit base were the type of people that were going to do that. So I didn't really think that was a big risk for them at the time. Also, the Fed had kind of come in and tried to smooth everything over for the banks. They had like the emergency window, I think, that they opened, and they did some other stuff. I forget exactly, but at the time I felt like most of the banks that were going under had done it, and the rest would be helped in one way or another. And that I didn't think their deposit base was a risk, like the other banks that did go under. So, but they do have, if I recall, like a lot of commercial real estate, like most regional banks, like loans. And so I feel like we've gotten the correction back up from the fear of the deposits fleeing, the deposit risk. But the just general regional bank risk, this is the only one that I still own. I sold all of them except for one, which was a Signature Bank, which actually did go under. So I did have one. The one that I didn't sell was one that went bankrupt, which is sad. But overall, I've done pretty well on banks, on the regionals especially. And I think it's just kind of balanced risk right now. And if the Fed's going to keep holding rates higher and doesn't seem too concerned, an economic slowdown becomes a little bit more likely, and that should be tougher for some of these real estate companies and so forth to pay back their loans. So I just think the risk is a little bit higher, and the reward is mostly, the easy reward is kind of back. It's baked in already. So I've got that. So because basically this past year and a half, the stock hasn't gone anywhere. So the risk was gone. I think the market maybe has this one right, but I don't see any reason to kind of to keep holding it, because you never really know with the banks kind of what the loan risk is until it starts going bad. At least for me, because I'm not a bank expert. So that's my thoughts on that one. Again, kind of just reducing the overall financial risk exposure in the portfolio. REITs are very similar. Sold most of those. I think I only have 2 REITs now. I set 10 positions aside in my portfolio for REITs, and they're down to just 2. So the other rest is in cash. I'd rather buy those after a real trough, a real credit trough, and it doesn't look like, I mean, we could just muddle through, right? But I don't think that's going to be great for REITs either. We really need like a trough and a reacceleration, I think, in economic like activity and growth and credit and all that stuff. So yeah, so let's see. So Comcast was pretty much break even. UMBF and Fidelity Information, those were winners because I bought them after little mini crashes. And then BMY and GMP were losses. I think all these together actually might have had a little bit of a profit. But I think by getting rid of these, going to short-term treasuries, collecting 5%, especially when balanced with my other growth positions and riskier cyclical positions that I can see them coming on my spreadsheet. Like I can see them getting closer and closer, especially the cyclicals. And even after you buy those, sometimes they can still fall 50%, even if they do eventually become winners. So it's nice to have kind of a nice pool of cash that you know you can keep buying. I want to be in a buying mindset if when things are coming down and getting cheap, even if in the initial stages, if you never really know how deep or shallow it's going to be. But the stocks you buy at the initial, like if you go back to March 2020, I mean, the stocks that I bought at the very beginning of March still suffered, the first couple weeks even still suffered pretty big drawdowns before that came back. And that type of recovery can usually take like 2 years. So you want to keep your confidence up. And again, with the other kind of smaller growth businesses, they're just more volatile anyway. And they take a long time to play out. So I want to be able to just have enough cash where I stay rational. I pick things when they come to me, and I don't have to worry about, the portfolio getting too volatile or getting too risky. And now that I have like 40% cash on one end and pretty much growth and cyclicals on the other end, like starting to build the cyclicals and growth, and then the longer term growth holdings that I've had, like big cap, like Tractor Supply, AutoZone, Berkshire. So I have some of those that I bought back in 2020 that are just kind of long-term holds now that have gone up a couple 100%. So it's not all like growth, but the new stuff that I'm buying are these deep cyclicals and growth mostly. If the market ever does get down where I can buy like a typical high quality like S&P 500 steady earning stock at a good price, then hopefully I have some cash left to be able to do it. That would definitely take a recession, I think, at this point. So I think I'm kind of stuck with this barbell with kind of volatile but growthy potential on one, cash on the other, a little bit of stocks that I bought a long time ago that have done well in the middle. That are kind of long-term holds at this point. And I feel really comfortable with that setup right now. So these cells just kind of enhance that a little bit. And then I think each one kind of had their own risks that I think have grown a little bit. All right, so if you found this useful, hit the subscribe button. Again, if you have a request or anything you'd like me to make a video on, like a specific stock, put it in the comments. I'll get it on the whiteboard behind me. Still have a few up there I haven't gotten to. If it's a stock that's in the S&P 500, I post those here on YouTube, and the rest I post on Patreon, which is $5 a month for the requests that are not in the S&P 500. And then there is a free tier on Patreon now too, where I post all the same videos I post on YouTube. And then also some thoughts on like books and stuff that I'm reading. I'm posting those just exclusively at that kind of Patreon free tier level. So there is some extra things there that aren't on YouTube for the free level Patreons. And thanks for watching, and I'll see everybody later. Bye.